Why I'm going full throttle into VTV, the Vanguard Large Cap Growth ETF. You don't have to, don't care, just tell you why I am. So if we look, I just did a video a few minutes ago about how Morningstar had projections of 1.8%. I think that was that was nominal going for the next 7 to 10 years. GMO, they're always negative Nellies, can't stand GMO anyway. Research affiliates had pretty low expectation. I think it was basically flat for the next 7 to 10 years, which is net of inflation. Who else was there? Vanguard's about 5, well, let's say 5 to 5.5. That was real return after inflation, if memory serves. Schwab is about 6 or so, 6 to 6.5. That was real return. I think that was net of inflation. I can't remember, real or not. I just can't remember. Either way, low returns is what I'm saying. Low returns. All right, that's no other way around that. We shall see. But I get it. We have a market that is relatively high price to earnings ratios. And historically higher price to earnings ratios lead to lower returns going forward. I mean, I got no qualm in that at all, none. But then interesting thing, I looked at my phone and the TNX, the 10-year Treasury yield is now 2.39. All right, so let's write this down. 2.39, 10-year T-bond. 2.39%. So, without even factoring inflation, we're just going to say taxes. We'll just say you're in the 22% tax bracket. Yeah, actually, no. Let's say we're in the 12% tax bracket, minus 12%, because you got to pay tax on this guy. All right? So, if you're in the 12% tax bracket, here's my calculator, you will net, let's see here, you're going to net 2.39 minus 12%, 2.1. All right, you see, yeah, that's what you're going to net for locking up your money for 10 years, 2.1. Now, if we have we'll say a 2% inflation, oops, and you can figure that out. It's going to be a 0.1% return. Can you see that? Yeah, okay, 0.1%. So you take this is what ticks me off, that they don't index the capital gains for inflation, because here you go, you're eating alive at your inflation. Now this isn't capital gains, this is income, same thing, because the tax brackets get adjusted to reflect the income that you pay. But here you're saying I am paying 12% on the entirety of my earnings, but I'm losing 2% a year to inflation of that. So this isn't my net, this is the only thing that matters, because inflation is eating alive my earnings as I sit there. So before taxes, my earnings that I actually can spend, my increasing purchasing power is only 0.39. After taxes, my increase in purchasing power is only 0.1, which stinks. All right, so that's the nature of the beast. All right, so let's look at these two guys right here, VUG and VT. This is the Large Cap Growth ETF. All right, this is the Large Cap Value ETF. Both from Vanguard. Should you do other firms? Maybe, I don't care. This is for me. I'm doing Vanguard. I like Vanguard. So I'll go make a trade after we're done this video. So a couple things. I'm getting 2.39% on the 10-year Treasury. What am I getting as a dividend yield on VUG? What did I do? Purple. There it is. Right now I'm getting 1.1%. All right. And if I'm still in the 12% tax bracket, what do I pay on that 1.1% dividend yield? 0 tax. Because I'm still in the 12% tax bracket. Because remember, qualified dividends are not subject to income tax if you maintain yourselves in the 12 or 10% tax bracket. So initially, right there, I'm far ahead I'm not far ahead. I shouldn't say that because I still got to pay inflation. But I am getting 1.1% real money into my pocket, but I am losing to inflation because inflation is still at 2%. And so this is not making me any money because I'm only getting 1.18 net of taxes, but I'm still losing 2% to inflation, if that makes sense. All right, but still, all right, there you go. So I'm getting 1.1 as a dividend yield, nothing to write home about. What's this guy doing right now? This guy is paying me 2.76% dividend yield. Nothing to tax, minus 2% to inflation, which means that 0.76 is what I'm getting real purchasing power increase. Now, again, that might not seem like much, but every penny helps in a low interest rate, low return environment for sure. So I'm getting, what's that, almost 3 times on the VTV as I'm getting here. All right, now there's a reason for that. You ready? Because the PE ratio on this guy is 30. All right, the PE ratio on this guy, you got to be careful when you look at these charts. I looked at one on Google. It said the PE ratio is 10. I said, that seems awful low. It's actually 20, according to Vanguard. So just be careful when you look at one stock chart, because if it's Google or sometimes Yahoo is jacked up. All right, so let me show you what I'm saying here. They both have hundreds of stocks in there, hundreds of constituents. So when you're investing is a matter of what else can you put your money in. And if the other things you could put your money in is a 10-year Treasury bond, or you can put your money in real estate, or you can put your money in gold, or you can put your money in stocks, international, domestic, whatever. But there has to be something else to put your money into. I mean, this is what's the opportunity cost. So if I'm going this direction, inherently I can't go with that at least amount of money. And so here, what I think gets overlooked all the time, but the negative Nellies is the fact that 2.39 is all you're getting on the 10-year Treasury, and for some of the 12% tax bracket, they're basically breaking even to have taxes inflation. That's not going to get the job done. They want to see some growth there for sure. So people say, will I be willing to pay up for a price to earnings ratio, because that bond isn't going to give me anything. Historically, the 10-year Treasury is about 5.5. So if I get 5.5 historically, and I can get a 30 PE here, all of a sudden that 5.5 10-year Treasury looks a lot more attractive. But the 10-year Treasury is not 5.5 today. The 10-year Treasury is 2.39. And so you got to say, what is the alternative uses of my money? If I invest here at 30 PE, I'm getting 1.1% dividend yield, but it is a pretty high price to earnings ratio relative to historical norms. That makes sense, though, because the historical norms on the bond, the alternative to investing, is so low. Does that make sense? But the best alternative is this guy, in my opinion, because here I'm getting almost 3 times the dividend yield. I'm getting more than the interest rate on the 10-year Treasury, but more favorably taxed, and I'm getting upside potential on the growth too. And the PE ratio is only 20. Historically, the S&P 500 has been about 15.5. So I'm getting a 20 PE, which is historically more. I get it. That's 33% more than historical norms on the S&P 500. Now, it's probably even more than on the value side of it. I mean, it might be 50% more than historical norms. But this is the world we're living in, all right? So we're living in a higher PE ratio yield. This is just the inverse of the PE ratio. I mean, if you looked at the inverse of the price relative to the yield on these Treasury bonds, so the PE ratios in that regard, and again, it's not really earnings, but if you look at the inverse yields, what they call it, this would be through the roof relative to what this is. Certainly relative to this, but certainly relative to what that is. So here I'm saying, I'm getting a moderately high PE ratio. 20 isn't extraordinarily high. That is not nosebleed seats, my friends. That's not. It's higher than average, but it's not extraordinarily high simply because this right here. So I'm getting a moderately high PE ratio, a high dividend relative to anything that's out there, 1.1, 2.39. All right, I'm still getting a bunch of holdings right here in terms of the hundreds of shares that are in that. So if one, Bethlehem Steel's among the group that goes kaput, it's not going to kill me. Now, I guess the alternative would be I could invest in my house. Yeah, absolutely. You could pay off your debt for sure. Let's say your debt's costing you 3 to 4%. Man, I got no problem with that. None whatsoever. Not getting any compounding, but you are paying off your debt. That would be another alternative. Like, say, forget stocks at all, because I still think the PE ratio is too high, the yield's too low. I'm only getting 2.76, but I'm paying a stupid bank 4%. I don't have any qualm with that. But don't do that in lieu of not getting the match from your 401k. I mean, that doesn't make any sense. So I got no problem taking your cash that you don't know what else to do with and put it towards your home. You still have to have liquidity, though. This is one thing I think a lot of people overlook. Having a home that's paid off is great, but it's only great until you can turn it into an asset which you can live off, either reverse mortgage, sell it to downsize, or take one of those unison loans like I talked about last week, where you sell a proportion of the future equity increase, which I'm interested in. But this is why I think this is very attractive. And typically, I don't say buy this or don't buy that. Simply because I frankly just don't care. I don't pay much mind to it. But facts are, if I'm getting a higher dividend on the large cap value at a lower tax rate with a PE ratio that's actually reasonable, that sounds attractive to me for sure. Especially when everyone and their mom is saying we're going to get between 0 and 5% rates of return, every single bit I can gather and compound, because don't forget, dividends, they do compound. They reinvest in shares. Those shares get that dividend too, is compounding. This isn't compounding, this is. So if I can get squeeze out 2.76 yield relative to the alternatives out there that has a potential for compounding at a moderate price to earnings ratio, I mean, that is high. That's not even nosebleeds, but that's high. Don't get me wrong. I'm going to take advantage of that. So that's what I'm doing today. I'm buying VTV. I'm getting rid of my target fund. I'll probably keep some Russell 2000 in there because I do like small caps as well, but I'm getting rid of all my, no, not all of it. I'll put the bulk of my 401k into this guy right here. Will it pay off? Man, I got no clue. We shall find out. But that's what I'm doing. Anyway, something for you to look at. Just remember, be careful when you're looking at stock charts from Yahoo, from Google, from Morningstar. Make sure you go to the source, which would be the fund company, and then back it up by looking at like Market Watch or something like that. All right, we'll see you next time.